Friends, in this video for ithought Advisor, I'm going to talk to you on the topic, the lower risk approach to higher returns. Most people tend to think that if you need higher returns, you need to take higher risk. But taking lower risks can also be a ticket to higher returns. Buying sectors or themes which are out of favor, which could create a dramatic multiplier in performance, usually helps us achieve this. Buying FMCG or pharma 10 years ago was actually a low risk approach. Today, it is seen as a high return outcome. The fact of the matter is, business cycles are much longer, more arduous, very challenging, and when a business or an industry overcomes that cycle, it tends to come out in shining light and performs superiorly. This happened in the pharmaceutical sector in the last 15 months. It's happened in the FMCG sector for a longer duration of time. But it would happen in some other sectors in the coming years. We are going to see a very different economic context emerging out of COVID. This context is going to be reform-centric. It is going to be government investment-centric. It is going to be change-centric, and it is going to be digital-centric. So when you are going to see all these things, there could be businesses which will become better allocators of capital. There could be businesses which disproportionately benefit from this, and there could be businesses which get re-rated with a change in ownership. So these businesses may not be factoring in these changes at the present circumstance. So when the change happens, when markets are convinced that the change in circumstances are sustainable, then it would be willing to re-rate these companies. But until then, these companies will still continue to trade as lower risk opportunities, as businesses which are not yet fancied by the market, as businesses which are waiting for event-based evidence or performance-based evidence or both. We see a constant supply of such opportunities in every cycle across market cycles, and buying those opportunities for you, even if it's in a mutual fund, will be richly rewarding because the risks are very controlled. They are very low compared to buying high growth companies at high valuations. So in that sense, we believe that buying at very comfortable valuations definitely lowers the investment risk for you, and by building positions when the valuations are in favor and then running those positions for a reasonable period of time, we would be able to give you higher returns despite taking modest risks. So that in essence has been what Team ithought has been focusing on for the last decade, and we have curated a number of such strategies for you, and those of you who have been with us over this decade have first-hand experience of how these strategies work, how they stay very soft for 2-3 years and then suddenly catch speed and turn out to be performing ideas. So we see such ideas at every point in time. Right now, there are enough winners if you're willing to take these lower risk ideas which the markets don't fancy. We would be able to build significant positions in them now so that when the market fancy catches, you will be ready to profit from them. So that is the opportunity. Low risk is a route to higher returns. We have done it repeatedly across market cycles, and we invite you to do it again after the next market cycle as well. Thank you very much for watching this video.